Now, in a single company's financial statement question, what we have to perform is, number one, the question might ask you about the income statement or statement of comprehensive income, or it might be a statement of financial position, statement of changes in equity, and might be like adjustment with regards to errors. These are the topics normally examinable in single company's financial statement. And most of the time, the standards that are being examined are, the key standards are, let me tell you what are the key standards. And then we'll focus first on the standards and then we'll solve this question. So key standards usually asked in this question is IAS 12, that is taxation. Another issue is IAS 16, that is property, plant, and equipment, along with IAS 38, intangible assets. You have to learn these standards for this single company financial statement question. And then sometimes IAS 36, the impairment of tangible as well as intangible assets. IFRS 9, financial instruments. IFRS 15, revenue recognition. Most of the time, examiner asks about the construction contract under IFRS 15. IFRS 16, leases. These are the key standards that you have to face in the single company financial statement. But sometimes some non-important standards can also be asked, such as IS2 inventories, IS 37 provisions, IS 8 change in accounting estimate, policy, and errors. So we can expect anything from the examiner, but on the basis of the past exams, the most examinable standard here is these one, which I have listed just now. Now, before moving on to the question practice, let me just give you an insight that what is typically being examined in IS 12, 16, 38, IFRS 9, so that you can understand that for this type of question, how much knowledge of a relevant standard is needed. So let's begin with that. What type of adjustment is needed with respect to taxation? That is IAS 12. A very important standard for your examination point of view. So under IAS 12, you know that the standard deals with all the tax related issues. It's taxation. So primarily we have two issues, that is current tax, and the second one is how to deal with the deferred tax. Typical adjustment is the business estimates the current tax. So we need to identify the current tax estimate. First one, it will be given you in the question that there is a current tax estimate. It might be a refund as well. So what you have to do, if there is any under provision of tax, then what you have to do, under provision, we need to add into it. Or if there is any over provision, then we have to deduct this over provision from our current tax estimates. And this is the amount that I need to shown in the income statement as tax expense if it is a positive value, or a tax income, that is a refund. In the case of a refund, it might be a negative value. So this is very simple. Tax estimate will be given to you and you have to identify whether there is an under provision of the last year or there is a over provision of last year. Remember one thing, you can identify under or over provision how it has been given in the trial balance if trial balance shows a debit balance, it is always an under provision. And if trial balance shows a credit balance, then understand that it's an over provision, and then you have to deduct from the current tax estimate the over provision and add under provision. The next thing that we have to deal with, which is a bit complex and requires a learning understanding of IS 12, is deferred tax. And there are two deferred tax consequences. It might be a deferred tax liability given, or it might be deferred tax asset. Remember, most of the time, the examiner asks about deferred tax liability rather than deferred tax asset. But we should know both deferred tax liability as well as deferred tax asset. Now, in order to find out the impact of liability or asset, what will be given to you in the trial balance, there will be a brought forward deferred tax liability will be given to you. For example, 100,000 is the brought forward deferred tax liability given to you in the trial balance. Now, what you need to do, you have to identify the closing deferred tax liability. Suppose it is 1,20,000. It might be more than the opening balance, or it might be less than the opening balance. So you need to identify, if it is given, then you need to identify whether it's a decrease in deferred tax liability or increase in deferred tax liability. There might be either increase in deferred tax liability or decrease in deferred tax liability. Now, this is simple when closing deferred tax liability is also given in the question. But if it is not given, then you have to calculate the deferred tax liability. And what we can do, we have to identify taxable temporary differences. If taxable temporary differences are given at the end, then simply we need to apply the tax rate on it. And if we multiply the TTD, taxable temporary difference, with tax rate, this will give us a closing deferred tax liability. Or sometimes you might be given increase in taxable temporary difference or decrease in taxable temporary difference. So you need to check from the past exam papers that how examiner asks this type of question. If there is any increase in deferred tax liability, suppose, what should be the treatment of that? Deferred tax expense debit 20,000 and deferred tax liability credit 20,000. So the impact is in profit and loss account, income statement, and that is in the liability section, that is the non-current liability section of the statement of financial position. So this is basically the adjustment related to IAS 12. Now, sometimes the deferred tax might connect with IAS 16, property, plant, and equipment. It might connect with revaluation. I will later told you that how we can connect revaluation with deferred tax. This is first issue that I'm going to address in the question. Now, the second thing that we have to face in single company financial statement question is very important standard. And it's very, very important standard for your exam, that is financial instrument. It might be in section A, it might be in section B, or it might be a part question, part adjustment in section C. So it's very, very examinable topic, highly examinable topic you need to deal with correctly. Now, in single company financial statement, you might be given like financial investment, how to handle financial investment. That is investment in shares. Another issue might be given is issuance of loan stock. And the third one might be issuance of convertible loan stock. Any one might be given. And most of the time, examiner gives you some errors in the calculation of issuance of loan stock and issuance of convertible loan stock. Now, in case of issuance of loan stock, what we need to do, we have to recognize liability at the end at amortized cost. This is the criteria. How to record, how to measure financial liability at year end at amortized cost. Now, how we can calculate amortized cost? So in order to calculate amortized cost, the brought forward liability, liability at start, plus you need to add finance cost using the effective rate of interest and deduct if there is any interest paid during the year. Deduct this interest paid and you will get the closing liability, which is to be shown in statement of financial position. This figures, that is finance cost, will be part of profit and loss account. And this figure will be part of SOFP. And one thing, remember always that this finance cost is to be shown as using the effective rate of loan rather than the coupon rate. So what is the effective rate? We have to show this as a finance cost in profit and loss account. So if there is any error given, we can handle in the question. Now, as far as the convertible debt is concerned, it might be given as, you know, that the accounting treatment of convertible loan stock. What is the accounting treatment overall? If a company issues a convertible loan stock, then we need to use the split accounting. We have to split this into two components. One is the liability component and other one is the equity component. You might have studied from your FR preparation that there are two components always. If a company issues a convertible loan note, there will be always two components. One is the liability component and another one is the equity component. Then what we will do with liability component and equity component? For liability component, we can record this liability component at each year end on the basis of the same amortized cost method I have told you few minutes earlier. Liability component. And for equity, there will be no subsequent accounting. There will be no subsequent accounting. What it means? The equity will remain the same at the original value. And what about the investment in shares? If there is investment given in the question and a company has purchased some shares, then it might be a classification as FVTPL category, or it might be classified as FVTOCI. You might have classified this as a fair value through profit and loss category or fair value through OCI category. So you need to identify the gain or loss, the increase or decrease in the share price only. And in case of a financial instrument measured at FVTPL, all the gains and losses will be part of profit and loss account. But in case of this, if there is any gain or loss, it will be part of other comprehensive income rather than in profit and loss account. So this is an overview of what we usually get in IFRS 9. Now moving forward to the next most important adjustment, that is IAS 16, property, plant and equipment. Typical adjustments normally given to you in the exam is identify depreciation, calculate depreciation for the year, which is very easy, not a difficult thing. Depreciation either given in terms of a straight line method or will be given as reducing balance. Along with, you might be given gain or loss on disposal calculation. But the most important thing is how to deal with revaluation deficit and surplus and deficit. Revaluation surplus and revaluation deficit. This is a tricky thing, that if the company's policy is to revalue at the beginning of the year or at the mid of the year or at the year end, then we need to identify revaluation surplus. And then after identification of surplus, then how this surplus can be realized, realization of surplus. And sometimes the deferred tax issue related with the revaluation surplus, which might be a difficult thing to handle. Deferred tax and revaluation, which I'm going to address in the question. These are the main items that we have to face in IAS 16. Along with another important adjustment is you might be given like IFRS 16 leases. So in case of IFRS 16, we have to handle two items, that is asset for lessee, that is right to use asset. We need to identify right to use asset. We need to identify the subsequent measurement, how to deal, what should be the entry. And then we have to deal with lease obligation. And you might be given lease obligation to calculate when rentals are paid in arrears, or a case might be given where rentals are paid in advance at the beginning of the year. Okay, so let's move to our first question of the day. Let's see what is the requirement of the question and what type of adjustment we have to see in this question. I've already shared this on your WhatsApp group. You can see question on your screen, as well as you can also see in the WhatsApp group. This is basically September, December 2002, I guess 2020 question. So first of all, whenever you have to solve a question like this, always see the requirement first. What is the requirement of the question? So as you can see, the requirement of the question is prepare a schedule of adjustment required to the retained earning of the Lord & Co. as at 30th September as a result of the information from note number 1 to 4, and it is worth 8 marks. Right? Adjustments are given 1, 2, 3, 4. First adjustment is related with IFRS 9. Second adjustment is non-current asset, depreciation, and kind of impairment. And third one is environmental provision, that is IAS 37. And fourth one is deferred tax. And then what we need to do? At the end, what we need to do? After this adjustment, we need to prepare a statement of financial position at 30th September 2008 worth 12 marks. All calculations should be rounded to the nearest 1,000. Now see, first we have to perform an adjustment in retained earning, and then we have to prepare a statement of financial position. Now for financial position, what I will do, I will first of all create a format of statement of financial position. Now see, you can see here from this draft statement of profit and loss given and summarized trial balance, we can identify what are the balance sheet item, and then we can directly insert these along with the adjustment. So we have equity shares, we have equity share capital, we have retained earning on which we need to make some adjustment. We have office building non-current asset, factories non-current asset, accumulated depreciation of both non-current assets. Similarly, environmental provision, we have current liabilities, current assets, loan notes, deferred tax liability, we have interest paid, and we have a suspense account that we need to clear this suspense account. It means there is some errors or omissions. So in the exam question, in order to save time, what you need to do for a balance sheet, we need to do what? We need to prepare a format of the balance sheet so that we can easily compile my balance sheet. So let me put this here, the basic requirement of the balance sheet. Wait 1 minute. Just wait. Okay. So suppose I have to start from here. So this is my SOFP. Now see, I know the format already. So first of all, the non-current assets. And how many non-current assets I have? First one is office building. Second one is factories, net of depreciation. Then you can use current assets. And then here you can show total assets. This is the asset side. The next one is your equity side. And this is your equity capital. How much equity shares are given? 10,000. So this is basically equity shares. Then we have the adjusted retained earnings. After that, we need to put non-current liabilities and then current liabilities. Leave some space here. It might be 2 or 3 items. So we can put here current liabilities. So this is the format of the balance sheet. So we'll prepare balance sheet side by side. And the first requirement is we need to make adjustment to retained earnings. Adjustment to retained earnings. Now see, the retained earning given in the trial balance, you can see in the question, retained earning given in the trial balance, 30th September 2008 is 4122 credit balance. So we have retained earnings at 30th September, and that is 4122. And we need to put adjustment now in this question. Now begin with adjustments. So adjustment number 1. Now see, this adjustment is related with IFRS 9. Now see, IFRS 9 adjustment, a loan note. A 5% loan note was issued on 1st October 20x7. Now 1st October means my trial balance has been given as, trial balance date is 30th September 2008. And the loan note is issued at what date? Is issued at 1st October 20x7. This is the opening balance. At a face value of 5 million. This is the nominal value. Direct cost of the issue is 0.125 million and were charged to profit and loss account. Now, this is the mistake. Whenever there is an issue cost related to loan stock, it would be net off from the issue cost, issue price, rather than to be charged in profit and loss account. So we need to adjust this 0.125 million. The loan will be redeemed in 5 years' time at a substantial premium that gives an effective interest rate of 8%. Now, this effective rate would be shown in profit and loss account as an expense. And annual repayment of 2,50,000. How? Which is 5 million par value, 5% coupon rate. So this is basically interest payment. Annual interest payment paid on 30th September is 2,50,000. Now see, in the given trial balance, interest is already recognized. It means 5% interest is already recognized. So we need to adjust that how much more interest we have to charge in profit and loss account, and then the impact on balance sheet. So we need to work out the loan note adjustment above all. And at the end of the first year, I have to identify my correct value. So I have to show some working here. Let me do some working, how to incorporate these two. So first of all, let me write here is loan adjustment. Let's put some loan adjustment. First of all, issue cost, and then the difference of finance cost. Now let's do some working here. So here I can start my workings. First of all, loan note. Now see, 0.125 million was charged to profit and loss account. So what I need to do with this 0.125? So I need to adjust. This is the par value, that is going to be 5 million. So 5 million. And then I need to deduct the issue cost from this. And how much is the issue cost? Issue cost is 0.125. So how much I need to adjust? 125. So as a result, I will get this figure. What is my answer is, I will get this figure 4875. So this is my original initial loan note value, right? And now this issue cost, I need to adjust this in profit and loss account. What would be the effect? Expense has been charged in profit and loss account. So it means profit has been reduced. So that means I have to increase my retained earnings. Okay. 125, what I need to do? I have to increase my retained earnings. So I have to add the effect here. So this is the, as I have to add this, so let me put here minus sign, and now select this cell and then see 125 is added in issue cost. Is this correct? Is this clear to you? You can see how I'm working along with this. I've already created a format of balance sheet. I've already created all the layouts, and I'm just working one by one so that I can save my time in the exam. And it's not necessary you can start with the loan note adjustment, but it's not compulsory. You can start with the easy one as well. In this question, deferred tax adjustment is quite easy. So you can start with adjustment number 4 as well. But as we are practicing this, so I have started from adjustment number 1. Now see, we have to identify two things here now. One is the loan notes amortized cost and the finance cost. So let me just calculate further. So initial value of loan note, it is given 4875. This is the value. So let me choose this. This is the value. Now, what is IFRS 9? What is IFRS 9? IFRS 9 says that when you issued a loan note stock, you have to identify the amortized cost. How? Just add finance cost. Finance cost. We need to add finance cost. Now see in the question, the effective rate is 8%. Effective rate is 8%. And I have to apply this effective rate on this 8%, 0.08. So that means this is my finance cost that is to be shown in profit and loss account as an expense, but already interest paid is deducted, that is 250. So deduct this 250. So this is the amortized cost. This is the amortized cost to be shown in balance sheet, statement of financial position. Let me calculate this. This is the amortized cost. It has given some error. So value error. Let me check this. Again, given some error. Let me check. 4875 initial value, finance cost is 390, interest paid is, maybe it might be given error because I've just copied it down. So let me just write the answer here. So amortized cost will be 5015. So let me insert it manually, 5015. This is the balance sheet figure. So what is the purpose of creating the format here? This is the loan note working, and that is 5015. So this is how easily we can identify the relevant working, and then we can transfer those working in the relevant section. Now, what would be the effect of this interest paid in finance cost? Already we have recorded this interest paid. We have to show 390. So in the retained earning, I have to show an adjustment. How much finance cost I need to adjust into this. So this 390, I have to insert here finance cost. I have to deduct 390. This is my finance cost. Because in the above trial balance, it is not adjusted in retained earning. Now see, in the loan note, you can see the loan note value is 5,000. The loan note value is 5,000. And in the balance sheet, we have shown the loan note value, that is 5015. So this is the first adjustment. Always when there is an error given, then first we need to adjust the error, and then we need to identify the closing balance of the financial liability, and then insert in the statement of financial position. Now, item number 1 done. Now let's move to item number 4, the easy one. That is deferred tax. At 30th September 20x8, the tax written down value of property, plant and equipment was 25 million. Now, tax written down value has been given, TWDV, that is tax written down value, 25 million. And the income tax applicable is 20%. So what we need to do? We need to work out the tax liability. So for which we need to identify the carrying amount of property, plant and equipment too. So we can't do adjustment number 4 without adjustment number 2. So let's forget this, move on to adjustment number 2 first. Sometimes it happens that for a adjustment, you need to identify another adjustment. Now see adjustment number 2. Let me highlight adjustment number 2, what has been given. See, Lord & Co acquired an office building for 20 million on 1st October 20x2, which an estimated life of 25 years. Depreciation is charged on pro rata basis, monthly basis. On 1st April, the building was deemed to be impaired as its recoverable amount was 12 million. Now, the impairment took place on 1st April 20x8 in between the year, and our accounting year is 30th September. April, May, June, July, August, September. So after impairment, the remaining life is 12 years. Ignore the deferred tax consequences of this revaluation. We don't need to consider the tax issue onto this. Now, after impairment, we need to identify the depreciation as well. So no depreciation has yet been charged on any non-current asset for the year ended September 20x8. Factory's depreciation is 15% per annum using the reducing balance. That means the office building is based on straight line method. Now, what is the carrying amount given in the question? You can see in the trial balance. Office building cost is 20,000. Office building accumulated depreciation at the beginning of year is 4,000. Now see, let's calculate the book value first, and then let's identify the impairment and other things. So my next working is related with office building. So office building cost given, from this cost deduct accumulated depreciation, find out carrying amount, that is book value, and then we need to identify its recoverable amount, which is given in the question. And the difference would be impairment loss. And then afterward, we need to calculate the depreciation. See in the question, office building given as originally it's 20,000 and depreciation 4,000. So it's 20,000 and depreciation is 4,000. So book value is 16,000 at the beginning of the year. But we need to deduct 6-month depreciation on the basis of a straight line method. So we need to identify 6 months depreciation. What is the original life? This is 20,000 divided by original life 25, and we need to multiply this by 6 divided by 12. So 400 depreciation, and we need to deduct this depreciation. So from 6,000, first we will deduct the depreciation and we'll find out the book value carrying amount as 1st April 2008. And how much is the value? That is 15,600. Now compare this with recoverable amount. Recoverable amount is given in the question, or impairment is given in the question. Let me check. On 1st April, the building was deemed to be impaired as its recoverable amount was estimated to be 12 million. So its recoverable amount is 12 million. So if book value is more than recoverable amount, then the difference is impairment loss. So here, impairment loss, IAS 36. How much is impairment loss? Is 3,600. So we need to adjust impairment loss. Now immediately you can put this into the retained earnings section. 3,600 impairment. If I'll charge impairment, it will reduce my profit and so as my retained earning. So this is the effect of impairment, that it will reduce my profit. So 3,600 is the adjustment here. Now, after this impairment, we have left with 6 months. So I need to work out depreciation now. 6 months depreciation. So 6 months more depreciation. Now the remaining life I have to consider, the recoverable amount is 12,000. Remaining life is revised to 12 years, 6 months depreciation. So this is, now this is the current value. Multiply by or divide by 12. This is life into 6 divided by 12 or 1 by 2. So this is the depreciation. This is the depreciation. Now see, total depreciation is 500 here and 400 here. So total depreciation is 900. Now how I can put this depreciation into retained earning working? Let me show it here, depreciation. And depreciation is an expense. It will reduce my profit. So 900 is the reduction in retained earning. So this is done. Depreciation is done. Now, see, after depreciation, what would be the recoverable amount? So my after recoverable amount, after depreciation, the asset value is retained earning 12,000 minus depreciation. So the book value at the end is 12,000 minus this one, 11,500. Now this 11,500, now this is the office building. Now see here, this is 11,500. Okay. So this is how we are accumulating marks from the question. And if you practice in such a way, it will help you out in reducing your time, right? In an exam question, it's very tough to handle this type of question, but as you go along, as you practice more such questions, you can easily incorporate these working into your Excel sheet. Now, the factory. Let's talk about factory. Lord & Co had 10 factories. On 1st October 20x7, that is at the beginning of the year, Lord & Co sold one of the factories with a carrying amount of 3 million. How we have calculated this? Cost minus depreciation. For 3.5 million. The only entry made in this regard is the disposal proceed, which have been credited to suspense account. Now, we have in trial balance one suspense account given, and that is 3,500 suspense account. So this suspense account entry was made as cash debit 3,500 and suspense account credit 3,500. So we need to adjust this suspense account. And how we can adjust this suspense account? Suspense account debit, and we need to recognize the adjustment regarding this factory. That is the gain or loss. We need to identify gain or loss. Now see how we can do this. First of all, disposal of factory, gain or loss. So here, let me work out factory. So disposal of factory, disposal. And the asset that we have disposed of, so proceed is 3,500 and carrying amount given in the question, it's 3,000. See, we have 500 of gain as proceed is more than carrying amount. Now, what would be the effect of this gain into retained earning? We have to add this 500 into our retained earning as gain on disposal. And that is 500 because it is an income. Okay. Now, another thing, we need to identify the depreciation of the remaining factory at the reducing balance method of, what is the rate given in the question? 15% per annum. Now, the carrying amount at the beginning of the year, I have to see the carrying amount at the beginning of the year of the factory given in the question, total in the trial balance. Factory cost is 40,000, this one. Depreciation is 11,100. So first of all, identify the opening book value. 40,000 minus 11,100. So this is minus. So this is 28,900. This is the book value. Total book value of all the factories. Now we have sold one, that is disposal, and the carrying amount was 3,000. So as a result, the value is now 25,900. This is the value. And I need to identify depreciation for the whole year, and depreciation rate is 15%. So the depreciation is 15%, that is 0.15. This is the depreciation. And after this depreciation, we have book value left. This is 22,015. Now put this depreciation 38,885 into this depreciation, further depreciation of factory, deduct this depreciation 3885 depreciation. It will reduce my profit. And now find out the factory's carrying amount. What is the factory's carrying amount given? So the factory's carrying amount after depreciation is 22,015, and this is the balance sheet value. 22,015. This is the balance sheet value. 22,015. And this is my total non-current assets to be shown in statement of financial position. Okay, so this is the adjustment related with factory. Now let's connect the last one, deferred tax. See here, the deferred tax adjustment. Let me connect deferred tax adjustment. So at 30th September, the tax written down value of property, plant, and equipment was 25 million. Tax written down value of property, plant, and equipment. And it is showing that it's talking about factory, the tax adjustment related with factory. So property, plant, and equipment. So it says that total carrying amount. So where is the total carrying amount? Here is the total carrying amount. Let me calculate first total carrying amount. So this is the total carrying amount. This plus this. This is the total carrying amount. 33,515. So this is the total carrying amount. Here you can put tax adjustment. Carrying amount is from the balance sheet 33,515, and tax written down value. Tax written down value WDV given in the question 25 million. 25 million. Now, whenever carrying amount of asset is more than, carrying amount is greater than the recoverable amount, carrying amount is more than the tax base, we can also say this is the tax base. This is the rule. Then we have taxable temporary difference, TTD. So just find out the difference, and difference is, how much is the taxable temporary difference? Is 8,515. So it's 8515 is the closing taxable temporary difference. This is the closing value. This is CF. And tax rate. So this is deferred tax liability. So what is the tax rate? Tax rate is 20%. So this multiply by 0.20, it will give me 1703. This is closing deferred tax liability. Now, what is opening deferred tax liability? It must be in the trial balance. So you can see here, deferred tax opening balance as a liability 1500, and closing balance of the deferred tax liability we have just calculated. So this is deferred tax CF and deferred tax BF. Let's identify deferred tax BF. It's 15,000. So that shows it's 1500. That shows increase in deferred tax liability, deferred tax expense, and that is 203 deferred tax expense. This deferred tax liability we have to show in SFP, and this deferred tax expense we have to show in profit and loss account. This we need to show in profit and loss account figure. 203 deferred tax expense. So it will reduce my profit. It will reduce my retained earning by how much? 203. So let's put a minus 203 here. This one. Deferred tax adjustment. So we have done with deferred tax adjustment as well. And now the last one is about environmental provisions. Now see, environmental provisions. Lord & Co has an obligation to clean up environmental damage caused by one of its factory during 20x7. The cleanup is due to take place at the end of the factory's useful life. The liability has been recorded correctly, and the balance at 1st October 20x7 beginning, showing the present value of that. Cost of capital is 5%. Now see, whenever we have to recognize any liability, remember, whenever we have to recognize any liability, present value of future obligation, what we need to do? First, we need to identify present value of obligation, liability. And after this, we need to find out unwinding of discount. You might know about it. What is unwinding of discount? That is, you have to increase the present value of what is already recorded using the cost of capital. Now see, in the trial balance, we have been given environmental provision at 1st October worth 1228. It's 1228. It's 1228. Now let me work out 1218. So this is environmental provision, opening balance, brought forward. It's brought forward. Brought forward is given. Let me check it again. Environmental provision balance 1228. 1228. Now, unwinding, which is a finance cost. Rate is given 5%. So discount factor is 5%. Discount factor is 5%. So what you need to do is apply a discount factor, discount rate of 0.05. This is the finance cost. We can round it to 61. And this is my CF balance. Okay. So this is my CF balance plus this one. It's 1289.4. I can write 1289. Now this finance cost 61, as it's an expense, so it will reduce my retained earning. 61 is retained earning, that is finance cost minus 61. This is the value. Now see all the adjustment. We have all the adjustment here. Let me check whether we missed any adjustment. So we have added back issue cost, then finance cost, then building depreciation, then impairment, then factory depreciation, disposal of gain or loss is also there, unwinding of discount is also there, and deferred tax adjustment. Now let's find out the total here. Okay, this is the wrong value. What is the total retained earning value? That is our first requirement is 4292. Now see, there is a minus sign. So it means we need to adjust retained earning. This is adjusted retained earnings, that is in minus. So need to put this in balance sheet as a negative value, 4292. 4292. So put this here, minus 4292. Now I have to compile my balance sheet. Non-current assets I have already created. Current assets, then equity shares, no adjustment in equity shares. Just put it down from the trial balance. Equity share is 10,000. Current asset is 14,700. So equity share is 10,000. This one. Current asset is 14,700 from the trial balance, no adjustment. And the total asset is now this one plus this one. This is my total assets. This is total assets. And what about loan note? Loan note is there, 5015. Now we have environmental provision as a non-current liability, right? And we have deferred tax as a non-current liability. Then we have current liabilities from the question, current liability from the trial balance. You can see current liabilities in the trial balance is 34,500. So it's 34,500. This one. Deferred tax closing balance is always worked here. Deferred tax closing balance is 1703. So deferred tax is 1703. Environmental provisions ending balance is 1289. It's 1289. And now this is equity and liabilities. So this is the total figure from this. So I have to total from here. Retained earning minus loan note, environmental provision, deferred tax, and current liabilities. So this is 48215. So our asset side and our equity and liability side is now tied up. So that means the whole question is correct. So this is what the single company financial question, first one, we have completed. Now, if you have any question regarding any adjustment, please ask in the chat box. I will answer that first, and then we'll move to the next requirement or next question, which I will be solving manually, not on the Excel, just to speed it up, the process. So kindly ask if you have any question. Remember, in order to perform well in a single company financial statement question, your standards knowledge, your standard understanding and practice must be really, really good. And practice those standards that I've already mentioned above. So, okay. Now let's move forward to another exam question. Another question, also the recent one. Now the requirement is slightly different. In the first part, we have to prepare a statement of profit and loss for the year ended 31st December 20x5, 12 marks. And then instead of balance sheet, we have to create a changes in equity for the year ended December 20x5. Now let's see profit and loss account and statement of change in equity. So let's see. Revenue is given, that is profit and loss value, cost of sales, admin, distribution, income tax, note number 3. We have to handle this. Deferred tax liability, this is IS 12. Provision again. And then we have intangible asset, IS 38. We have investment property, IS 40. Finance cost, investment income, and again, a suspense account. That is, something is missing. There is an error or omission. Now let me handle the suspense account first. See here. On 30th September 20x5, the company made a 1-for-4 right issue. What is the entry of right issue? We normally made an entry that is bank account debit and share capital credit and share premium credit. This is the usual right issue entry. The proceed, the exercise price was 3.50 per share. The proceed were correctly accounted for in the cash with a corresponding entry being made in the suspense account. That means the entry was made as bank account debit and suspense account credit. This was the original entry. Now see, suspense account is 46,500. So the entry original is bank account debit and suspense account credit. Now we need to do what? We need to adjust this. This is the original entry. So I have to put this original entry. Suspense debit by 46,500. I need to calculate share capital and share premium. Now, this right issue took place on 30th September 20x5. So what is the share capital? Share capital is 60,000 and par value is 1. That means number of share is also 60,000. So right shares, right is 60,000, 4:1. So that means the right issue number of right shares is 15,000. What is the price? Each share was issued at 3.50. So 15,000 into 3.5. Let me calculate how much is the value of right shares. So its total is 52,005. 46,000. Okay, let me check. What is the value? 15,000 into 3.5, that is 52,500. And the suspense account value is, so it might be a possibility that there is something else in the suspense account. Okay, let me do that. 52,500. this entry is also affect the suspense account. So for the time being, just leave it here. Share capital is, this is 52,500. So share capital is 15,000 and share premium is the excess, that is 2.5. So 15,000 into 2.5, and this is going to be 15,000 into 2.5, it's 37,500. So this is how we have to recognize this. And the entry, let me just remove this altogether. The entry would be suspense account debit by 52,500, share capital credit by 15,000, and share premium credit by 37,500. Both will be part of statement of changes in equity. Now, the number of shares is increased. Previously, it was 60,000. 15,000 new shares added, and the number of share is now 75,000. Now, another adjustment. MIMSCO paid a dividend of 0.04 per share, dollar 0.04 per share on all shares on 31st December 20x5. Now, before right issue, there were 60,000 shares, and after right issue, there are 75,000 shares. So dividend was given after right issue. So it means the dividend is, we need to work out dividend. So dividend is $0.04, $0.04 into 75,000. So how much is the dividend? Dividend is I guess it's 3,000 dividend. Let me check. It's 75,000 into 0.04. It's 3,000. So dividend is 3,000. Now, what is wrong with this entry? Recording the dividend paid in administrative expense. Dividend paid to ordinary shareholder. We can't record this as an admin expense. So we have to reduce the admin expense in profit and loss account. And dividend is to be shown in a statement of changes in equity. Deduct from the retained earning rather than in profit and loss account. Simple adjustment number 7 and adjustment number 4. Now you can see here, this is the admin expense, and one admin expense adjustment we need to make is we need to deduct 3,000 from here. So after deducting this, the value would be let me check after other adjustment. Okay. So now move to the easy one again. Let's focus on adjustment number 3 related with tax again. See, in the trial balance, income tax figure is given 140 on the debit side. Whenever trial balance includes an income tax figure on the debit side, this is the under provision. So this is the under provision. And now see, one is income tax under provision and deferred tax liability beginning balance is 7,700. Two items related with tax is given. Now see the adjustment. The income tax figure in the trial balance, this one, relates to under or over provision. That was on the debit side, so this is under provision. The current year tax is estimated to be a refund rather than expense, rather than liability. It's a refund of 1.2 million. In addition, the deferred tax liability Ending balance is estimated to be 8.2 million. Now, as in comparison with the last question, we have to calculate the deferred tax liability, but here the closing balance is given as 8.2 million. Now, see the tax adjustments. First of all, the current year tax adjustment. Now, we have a refund. We have a refund given in the question. So, tax estimate refund, which is negative. So, negative given is 1200. So, it's refund. So, that's why it's negative. It's an income. Add under provision. Normally, we add under provision. So, under provision is 140. We add under provision in tax estimate. So this is the current year tax adjustment, and that is 1200 income minus 140, and that is 1060, a credit balance. That is an income. Now, deferred tax liability. Deferred tax opening balance is 7,700 and closing balance is 8,200. So, increase in deferred tax liability. 8,200 minus 7,700. So 500 is an expense. So final figure in the profit and loss account is 560 negative. That is a credit balance in profit and loss account. This is my tax estimate. Adjustment number 3. Now see, adjustment number 1. It is related with an error in the inventory. The company noted there an error in the inventory count at 31st December 20x4. That is in the last year. Meaning that the closing inventory balance in the last year was overstated by 0.7 million. Now, closing inventory was overstated by 7.7 million. What would be the effect of this on a statement of changes in equity and profit and loss account? We need to identify, as we need to prepare our adjustment. So 700,000 or 0.7 million is the error. No entries have yet been made to correct this error. It means the inventory figure given in the trial balance. Where is the inventory? So cost of sales. This is the figure where we can find inventory. Cost of sales means opening stock plus purchases minus closing stock. So basically, this first one is a prior period error under IAS 8. And this we need to adjust from the opening balance of retained earning. So we need to adjust this from the opening balance of retained earning, this 43,200. We need to adjust this 700. Closing stock is overstated. So if closing stock is overstated, what would be the effect on cost of goods sold? If closing stock is overstated. Last year, closing stock of last year, that means opening stock of this year was overstated by 700. So it means that your COGS is overstated by 700. Overstated by 700. Now 700 has been there, cost of goods sold is there. So I will make an adjustment in cost of goods sold as deduct 700, right? Overall, its impact will be on gross profit. Now, the next adjustment is related with investment property. Point number 5, IS 40. So under IS 40, normally we'll record investment property either at the cost model or the fair value model. The company acquired an investment property for 20 million cash on January 20X5 and decided to use the fair value model to use account for investment property. As the property is expected to have a 20 years life, depreciation was recorded on this basis. The fair value of the property at 31st December 5 have been assessed at 22 million, but no accounting has taken place in relation to this. All depreciation and amortization is charged to administrative expense. There were no other acquisition or disposal of non-current asset. So now see in the trial balance, is there any investment property? So you can see here, we have an investment property which is worth 19,000. How come investment property is worth 19,000? So we have to investigate about this investment property and we need to adjust this figure of investment property, right? So first of all, original value of investment property was 20 million. Life was 20 years. And now its fair value is 22 million at 31st December 20X5. So if original value was 20 million on January 20X5, how come is this 19,000? Let's check investment property note number 5. Is what is the issue with investment property? Let me find out depreciation of investment property. So original value of investment property was, the cost of investment property was 20 million. Investment property purchase price cost was 20,000. Life was 20 years. So per annum depreciation is 20,000 over 20 is 1,000. So that means the carrying amount is 20,000 minus 1,000 is 19,000 reflected in trial balance, right? But as we are using the fair value model, so that means this depreciation is wrong. And it is already charged in admin expense. Here in admin expense, in administrative expense 10,900, we need to make some adjustment. So what we need to do? We need to reverse this depreciation. So we have to reverse this depreciation. Once we will reverse this 1,000, then the value of investment property would be again 20,000 and its fair value is 22,000. So there will be a gain of 2,000 on this investment property. So we need to record in profit and loss account the gain on investment property 2,000, right? Will show where we have to show the gain on investment property. So we need to make adjustment in relevant area. Now, next adjustment, the last one, that is about IS 38 brand name. Still, we have a suspense account balance. Originally, it was 46,500. One entry we have already recorded with suspense account 52,500. So let's see what is the effect of the brand. Yes, the gain is usually recorded in, added in gross profit, or we can show it as a gain as a separate line item as well. Once I will prepare the profit and loss account, then I will show this 2,000. See, This is the investment income. It's already there. So we can also add this 2000 here in order to make it 2500. Now, we have a brand name, intangible asset, 3300 on the trial balance debit side. Now see, incurred a number of expansion in relation to brand during the year and has capitalized the following cost as an intangible asset. 1.3 million cash was paid to promote one of its major brand, which is deemed to have an indefinite useful life. So originally in the trial balance, intangible asset is given as 3,300. And what is the breakup of this 3,300? One is 1.3 million to promote the brand. And the second one was 2 million to acquire a brand from one of the competitors. And the life is expected to be 5 years. M intends to sell this after 5 years. At the point of sale, it is estimated that the value of brand will have increased, and so no amortization has been accounted for in the current year. So what is the issue then with related to brand and its amortization? Number one, we have capitalized the promotion cost. We have capitalized the promotion cost of brand. We have capitalized this in the balance sheet, and we have to show this as an expense. This is an expense. It cannot be capitalized. Next thing is we need to charge amortization. So what is the capitalized cost of amortization? The purchased brand name, which is worth 2 million and useful life is 5 years. And 1st October means October, November, December, 3 months depreciation. So the amortization cost is 2 million. Life is 5 years. And amortization is based on this 2000 divided by 5 into 3 by 12. So amortization is 100, and this is an expense. So promotion expense as well as amortization expense. Last is adjustment number 2, related with some provision. The provision relates to a court case that was existed since December 2004. M settled this case for 6 million. Let's see. Provision as at 1st January 4,600. There is a provision balance in the trial balance, 4,600 as a credit balance, is a liability. And the settlement was 6 million. The full amount was credited correctly to cash credit, with a debit entry being made in the suspense account. So, what is the correct treatment? We settle this by 6 million. Brought forward liability was given in the trial balance, and that was 4,600. 4,600, and this is 6,000. Entry was made as suspense account debit 6,000 and cash credit 6,000. So we need to make a correction. So what is the correction? Suspense account credit. Already we have a suspense account in the trial balance given, and that suspense account figure is given in the trial balance. It's 46,500. It's 46,500 in the trial balance. Now, suspense account credit. In the right issue calculation, we have debited suspense account. Now here the suspense account is credit. Here suspense account is credit. Now see, this suspense account is on credit side. Suspense account is debit 52,500 already in the correction. So 52,500, this is credit, 52,500 is debit. And now in case of provision, suspense account, we need to debit by credit by 6,000. So it's credit 6,000. So that means the suspense account balance is nil. There is a correction. Okay. So suspense account is credited by 6,000. The difference, liability debit, liability is 4,600. Provision is debited by 4,600. And difference is to be charged in profit and loss account as an expense. This is to be charged in profit and loss account as an expense under administrative cost. Now, as we have to prepare a profit and loss account, we need to work out the adjustments related to cost of sales, admin expense, distribution, tax, and other things. There is no adjustment in revenue, as well as there is no adjustment in finance cost. So directly we can place revenue and finance cost without adjustment. So let's prepare profit and loss account. And let's compile profit and loss account. So here is my profit and loss account. First of all, the format, that is revenue, cost of goods sold, gross profit, distribution expense. Then we have administration. Then we have operating profit, PBIT, finance cost. We have investment income. And then we have profit before tax, taxation. And finally, we have profit for the year. Now let's put values here. Revenue given in the trial balance with no adjustment. Revenue is 24,300. So revenue is 24,300. Cost of sales, there is one adjustment, minus 700. So my cost of sales is 10,900. So my gross profit is 13,400. Distribution cost, there is no adjustment. It's 7,300. Admin working, I have to show. Afterwards, this is profit before tax. Finance cost, there is no adjustment. Investment income given in the question, 500 with 2,000 adjustment related to investment property. It's 2,500. And this is might be a gain or might be a loss. I need to work out the administration cost. Administration cost working. Administration cost given in the trial balance. Let's see how much administration is in the trial balance. It's 10,900. It's 10,900. Given in trial balance is 10,900. Now I have to make one by one adjustment in administration. So first of all, the settlement of provision. Settlement of provision is 1,400 expense. Then we have charged investment property depreciation in the expense. So that means I have to reduce this by 1000. Brand promotion, which was capitalized. So need to adjust here. Amortization not yet recorded related to brand 100. This is an expense. Okay. And dividend of 3000 was recognized in admin as an income. So 3000 negative balance. So this is the adjusted value and it is 9700. All the outcome from the adjustment related to investment property. So my investment property value done, investment income, administration cost is done, is 9700. Expense is more than gross profit. So there is overall loss before tax. This is loss before tax. 2500 is loss before tax. Sorry, loss before operation is loss before operation is 3600. Then we have finance cost and investment income. So we have a loss rather than it is loss, which is loss before tax. Taxation. Taxation adjustment. We have already done taxation adjustment. The first one, 560 credit balance as an income. 560 credit balance. So this is loss. So 560 is a positive balance against loss. And overall loss for the year, this is loss for the year. This is also loss. This is operating loss. Loss before tax. And this is loss for the year 1940. The second requirement of the question was to prepare a statement of changes in equity worth 5 marks. And we have been given equity share capital 60,000. Then there is a right issue, retain earning, opening balance, and is there any premium account? So you can see there is a premium account. No premium account is given in the trial balance, but we have made an entry. Share premium credit by 37,500. Okay. So let's prepare a statement of changes in equity format. SOCIE. So one item is capital, another is premium, third one is retained earning. Opening balance, balance at start from the trial balance, 60,000 was the capital balance. There was no in the premium account and 43,200 was the retained earning. Now, there was a prior period error in the inventory value. In the opening stock was, the closing stock of the last year was overstated. So closing stock of the last year was overstated. What would be the effect in the retained earning? Because it is a prior period error. So closing stock of the last year was overstated. That means cost of goods sold was understated and profit was overstated. So the impact was profit was overstated. Now deduct this 700 from retained earning. So this is the adjustment, right? Now afterward, this is the restated balance. This is the restated balance against IS 8. Okay. So now add one by one. Loss for the year. It will reduce my retained earning. Loss for the year 1940. It's 1940. Okay. Dividend paid 3000. We have deducted this from the admin expense. We have to deduct this dividend from retained earning. issuance of shares, right issue. 15,000 was credited in the capital, rest was credited in the premium account. What was that premium value? It was share premium credit by 37,500. So we have share premium 37,500, and this is my closing balance. This is my closing balance. Capital account balance at end 75,000. Premium 37,500, and retained earning would be 37,560. This is the ending balance. So what was the question? How many adjustment was there? Question was that prepare a profit and loss account worth 12 marks, prepare a statement of change in equity worth 5 marks, and the remaining 3 marks were related to cash flow statement. So in this question, number one adjustment was related to an prior period error. Second was IAS 37 provision. Third one was tax refund and deferred tax. Fourth one was right issue with suspense account. Fifth was investment property error. And sixth one was a capitalized brand name and no amortization was recognized. Seventh one was dividend was charged by mistake or in error to administrative expense. Okay, so we have made some omission errors against the suspense account, completed our profit and loss account, which resulted in loss, and then the statement of changes in equity.